Hey everybody, Chris Englebert with Englebert Financial Advisers in beautiful, hot, steamy Allentown, Pennsylvania, here at the first week in August. What do we do every month? The first of the month, we do our investment strategy update. And again, the bulls are running on Wall Street. You can see by my cartoon here, we literally have a stock market that's starting to go vertical. So here's a chart of the S&P 500. All the good news is out. Inflation has been better. We've seen better corporate earnings the last couple of weeks. Several of the big banks reported earnings much better than expected. The Fed's getting closer to ending the raising of rates on the short end of the scale. So again, all the news is out. And it's all been good news. And that's caught a lot of investors by surprise. We had a real hot finish to the end of June. July started off strong and July continues. Now, if we end up where we are at the end of July, we will have had 6 months of a rally in a row. Again, our risk indicators are elevated right now. We've been trimming positions, raising cash. And I'm not looking for a big market sell-off, but it would not be unusual to get a 5 to 7% pullback literally at any time with how the S&P 500 and the NASDAQ in particular have gone vertical as far as the stock market goes. Let's talk about interest rates. The 10-year Treasury is still stuck in a trading range. You can see by my chart here, that trading range is around 3.3% on the downside and about 4% on the upside. Every time we see 4% on the 10-year, that looks to be value and investors come in and buy it and rates go lower. Every time we get down to about 3.3 to 3.5%, you can see that investors sell their bonds. So boring is good right now because unlike last year where interest rates went straight up and we saw massive losses in the 10-year Treasury, literally the 10-year Treasury was down 15-16% last year. We are now getting a much calmer bond market. We're seeing bond yields around 3.5 to 4%. On the short end of the scale, again, bank CDs look to be the best place to be right now. 3-month bank CDs as of this video are 5.3% for a 3-month bank CD, something to take advantage of for the foreseeable future. The question is whether or not longer term interest rates go up or go down, depending upon whether we get a recession. Right now, it doesn't look like we're going to get a recession. So you've got the 10-year stuck in a trading range. And again, anytime it gets up to 4%, we look to buy some 10-year treasuries because that seems to be a value from that particular standpoint. Let's talk about crude oil. We haven't talked about crude oil for a while. We were very bearish on crude oil about the last 15, 16 months. You can see that it bottomed earlier this year down in the low 70 range. It is now back over $80 a barrel. I would not be surprised to see crude somewhere in the mid 80s. Now, what does that mean for you, the consumer? Gasoline and diesel prices are going up. If you've been watching at the pump, we've seen gasoline and diesel prices jump by 25 to 40 cents. I would not be surprised to see them rise a little bit more than that because obviously they're directly correlated to the price of oil. Now, one of the bad things about oil prices going back up is that at some point down the road, this is going to feed into inflation numbers. So we got some really good inflation numbers in the month of May and June, but I would not be surprised to see the back half of the year, those inflation numbers perk up a little bit. And the question being is, what's the Fed going to do? So what does this all mean for August? Well, equity indices continue to rally in July. We had a perfect storm of good news, lower inflation numbers, better earnings, and the Fed getting near the end of their rate hiking cycle. The question is going to be over the next couple of months is whether the Fed sits on the sidelines or because of these potentially increased inflation numbers start to ramp up the Fed hiking cycle again. So as far as the equity markets go, we're enjoying the rally right now, but we are closer to the door, taking some profits on extended positions, raising some cash, looking for that 5 to 7% pullback that could come at any time. Bonds continue to trade in a range. It's a big relief for investors because, again, for the first time in a year, bonds are working. People are collecting their coupons. We're not seeing big swings in prices as far as bonds go. So bonds are working, and especially the short end of the bond market, CDs are working very well at this point in time. Oil prices have turned around. Again, we see a lot of firmness in the oil market. That's going to feed through to inflation numbers. There's also some higher prices for wheat, corn, and soybeans. So again, if you remember at last couple of videos, I was pounding the table that inflation was coming down and coming down fast and hard. I would not be surprised to see it tick back up at the end of the year. The question being is, what does the Fed do? We think the Fed stays with increased interest rates right where they are now, 5.5% for the foreseeable future, well into 2024. Again, we've also had some good employment numbers showing that the economy is much stronger than what people realize. And so far, there's no recession on the horizon. So that's the update for August. We'll be back next month. We'll talk to you some more. Stay tuned. Take care.